Niall Ferguson is the Tisch Professor of History at Harvard and the author of many books, including The Ascent of Money, and most recently, High Financier, The Lives and Time of Sigmund Warburg. Niall is here with me right now. Niall, let's start with this. Tax breaks for business investment. That's what we're hearing from the administration. We're going to get more from it from David Axelrod in just a few minutes. And infrastructure spending. Now, take us back to previous challenges that governments like that of Reagan and Thatcher have faced. Is this what they'd be doing? And more importantly, to your point about business confidence, is it enough?
Well, I think it's good that we're now talking more about tax cuts and preserving tax cuts, not raising taxes, rather than dreaming of yet larger stimulus packages. So I have a sense that over the summer, some reality has set in the minds of people taking decisions in Washington about the economy. But if you think back to the late 70s, which was another time of great economic crisis, though the crisis then was an inflationary one, not a deflationary one, the critical thing that both Margaret Thatcher and Ronald Reagan did was to change the game so that confidence returned to business. And that need to change the game seems to me crucial at a time when business on both sides of the Atlantic is very, very hesitant about new investment, about new hiring, and there's a great mood of anxiety, including anxiety among many strong supporters, at least former strong supporters of President Obama. So I do think confidence is crucial here, and the administration has to do an awful lot more between now and November to bring that confidence back.
Niall, echoes in your comments right there of an op-ed you had in the FT a few months back in July. At the time, you said the Keynesians, embodied perhaps by the current administration, hadn't learned anything since 1935. In the few months since then, have they?
Well, some, I think, are learning, and others cling to, John Maynard Keynes's relatively simple model of how you bring an economy back. The argument that I've tried to make consistently now for, nearly 2 years is that under conditions of excessive private sector leverage, it's unlikely that a great splurge of public sector borrowing is going to bring about recovery. Keynesian policies can work under certain very specific conditions, but we have a very open economy, so there's a lot of leakage if the government does stimulus. And we also have the problem that with a very rapid build-up of debt, even with low interest rates, you can see interest payments on the federal debt begin to consume a larger and larger share of tax dollars. The US is in the grip of a structural crisis of public finance, and adding on Keynesian stimulus has actually made that crisis worse. Right now, I still don't see a sign that the administration has a credible plan to get back on track, by which I mean to tell us how in the next 5 or 10 years the United States is going to get back to fiscal equilibrium, back to a balanced budget.
Okay, but you can only balance the budget two ways. You can either cut spending or raise revenue. On the one hand, you want to see spending, taxes at least remain low as opposed to raised. What are the chances, though, that we're going to get a credible plan from the administration on spending cuts, which is the only other way, with 2 months, a little more than 2 months left before the midterms?
Well, is there anything lower than a 0% probability? I mean, it's politically almost inconceivable, and yet from an economic point of view, it's really desperately needed. There are huge question marks over the credibility of US fiscal policy. Morgan Stanley did a report just the other day which reiterated a point I've been making for ages, that the situation in the US fiscally is actually worse than the situation in Greece. There's this huge overhang of debt and a very narrow tax base and a relatively slow-growing economy. The key to getting back to equilibrium is, of course, growth, which you didn't mention. If you get the fiscal mix right, if you get the right kind of cuts in entitlements, then you take away this fear that the United States is on track to be a kind of super Greece at some point in the next few years. And that is the thing that I'll be looking for. I don't think it's politically unpopular for somebody to say, whether they're a Democrat or a Republican, look, I'm serious about getting this deficit under control. I want to do something about this crisis. When someone like Paul Ryan says it, and I think he embodies a new spirit among younger Republicans to get serious about this issue, people listen, and the polls show that voters take it seriously. So I think we've got to get away from the idea that talking seriously about reforming Medicare and Social Security is like grabbing the third rail of American politics. I think that's got to change.
Niall, before the break, we were talking about how to balance the budget and whether we're ever going to hear in the near-term frame whether a credible plan, as you put it, from the Obama administration, and you say there's a 0% chance of that happening. Let us turn our attention, though, to markets, because one of the distinguishing characteristics of your research into financial history is your focus on the markets, exchange rates, bond yields, stock prices. If you look at the financial markets today and assess them in a historical context, does what you see make sense?
Well, yes and no. Some of it makes sense. The stock market, for example, isn't really doing anything too surprising. We avoided the Great Depression. If we'd had the Great Depression, people's investments in the stock market would currently be round about down 85%. Now, we're not in that mess, and so that much I'm not surprised by, but nor are we seeing a kind of huge rally. And there isn't going to be some magical rally, I think, anytime soon, with the economy essentially flatlining. The really interesting action is in the bond market, though, where many people are baffled by the fact that with an exploding public debt that's doubled in relation to GDP since 2001, we actually see bond yields at historic lows. And there are those who say, well, this just proves that we can borrow even more and we should have a sort of super stimulus on top of the one we already had. And I think that's just plain wrong, because what we're really seeing at the moment is a kind of financial repression, not a depression, but a repression, where we're using very low short-term interest rates by the Fed in order to effectively keep the interest rate term structure much lower than it would normally be. There's also the phenomenon that people are pouring into treasuries every time they get scared by anything else in the world. And this belief that treasuries are a safe haven is what's driving a lot of the market action. And it creates some very perverse signals. Who wants to be a saver right now with rates this low? And that's, I think, an extremely important part of the story that we don't hear enough about.
Neil, how do we square your concerns about the U.S. deficit and debt with what we're seeing in Japan? They have their own debt problems. They're enormous. Yet the yen is trading at a 15-year high against the dollar, which itself is trading relatively strong against the world currencies. How does that make sense?
Well, I think the nightmare scenario for both the United States and Europe is to go the way of Japan and to end up with an exploding public debt, but something very close to deflation, and then a deflation expectation cycle which causes people just to be permanently pessimistic. Then you end up in this very low equilibrium with low growth, low interest rates, and exploding public sector debt as you desperately try to kickstart the economy with Keynesian methods. It didn't work for the Japanese, and I'm very much afraid that we're kind of rerunning that experiment and not learning really quite enough from their mistakes.
Neil, before we go back to politics for a moment, you've had plenty of criticism for the Obama administration and its policies, but what would our prospects for growth and prosperity look like under Republican policies, or perhaps those who are most concerned about the debt and deficits, the Tea Party?
Well, there's a big mutation going on in the Republican Party. I think if John McCain had become president, we wouldn't necessarily have seen radically different fiscal policies. I can remember looking at his fiscal math, and it looked like an explosion of public debt to me. So I think the key question for November is, how far is the Republican Party changing? How far is it serious about deficit reduction? And is the spirit of the Tea Party actually going to affect mainstream Republican candidates? I very much hope so, because I think that's what we need to see in American politics. At least one party that's serious about fiscal stability.
Neil, an endorsement of sorts for the Tea Party. Before you get a call from Sarah Palin, tell us exactly what it is about the Tea Party movement that you think the Republican Party and perhaps even the current administration needs to consider.
Please don't run the word endorsement. What I'm saying is that there are elements in the Tea Party movement that are healthy. One important element is the focus on fiscal stability and getting serious about the deficit. I think that is a healthy element, because the Republican Party had lost its fiscal virtue years ago. They stopped being serious about that issue, and the slogan that deficits don't matter got the Republican Party into a lot of trouble. So I'm very glad to see that mood is changing. The other thing that's quite encouraging is that this is a right-wing Republican movement that isn't obsessed with moral and religious issues, but is focused on what I'd call constitutional fundamentalism, getting back to the basics of the Founding Fathers. Now, those are not bad things. Of course, there are other elements in the Tea Party that are distinctly dubious, but that's always the way with populist movements. I said when this crisis struck, which is now 3 years ago, that we would see populism in a backlash against the excesses of the financial boom, and that's exactly what we're getting. And as usual with populist movements, it's a little bit like a non-heat-seeking missile. You never quite know what the target's going to be from one day to the next. So no, I'm not endorsing it, but what I am endorsing is, I think, a greater realism in the Republican Party, particularly embodied by, I'd say, Paul Ryan. Realism about the fiscal trajectory and the need to get that debt under control. If we don't have any seriousness about that in Washington, I think the US is going to get into big trouble.
Neil, you, just like we, heard David Axelrod talking about the president's plans for the economy, a lot about tax cuts and opposition to extending the Bush tax cuts for the highest income earners, but again, still a lot on tax cuts. Did you hear enough to make you think that they're playing this the right way?
Well, I enjoy David Axelrod saying that the Republicans are going to play politics with this, like he's not playing politics. It's very ingenious and I think a clever move on the administration's part to use tax cuts as a slogan going into these midterms. It's very new language, actually, for them, and I think it represents an attempt somewhat to reposition the president as a tax cutter rather than a big spender. I think it's good politics, and it certainly makes sense to extend those tax cuts, not to go in any way towards tax hikes in the short term. But the big question is whether there's a medium to long-term plan to stabilise public finances, and I don't see any sign of that at the moment, frankly, from either party.
Well, the one thing that David Axelrod did not say is that the president would veto any compromise to extend the tax cuts for the highest earners. Is that dangerous ground? Do you think, from a tax policy perspective, that that's something that we should be prepared to do if it means getting the Republicans on side?
I think he'd be very unwise to get into the position of vetoing. He's a president who's going to have to get used to working with a much more hostile Congress, let's face it, after these midterms. So he should get some practice in with compromising on these issues. So I think this can't be a deal breaker. It's very important that there should not be anything smacking of a short-term tax hike. And that is absolutely crucial at this point, because I think that would be very damaging to confidence if you got the wrong headline coming out of yet another gridlock in Washington.
Well, Neil, it is always a delight to have you here, your perspective on fiscal spending, stimulus, tax cuts, David Axelrod, and, of course, the bond markets. Niall Ferguson, the Harvard professor of history.